So I bought my first stock at the age of 19, and I started out with around $10,000. It took me around 6 months to actually save up. And by the way, I was not an expert. I would say I had a 20% chance of success and almost an 80% chance of actually losing. And back then, I bought around 5 stocks. 3 of those stocks did okay, one did absolutely terrible, and one did very, very good. Now, I didn't know this back then, but this right here is called the rule of 5. It's the idea that whenever you buy stocks in 5s, usually 3 do okay, 1 does terrible, and 1 does great. But that great one offsets all the money, and that way you make a lot of money. And by the way, when I bought my first stock, I had to pay $10 just to buy it. I had to pay $10 to sell it. With these are different times a lot better. Now, before I start this video and I tell you about 7 things to look out for before you go ahead and buy a stock, questions to ask yourself, I want to say one thing. I want you to forget about the idea of buying just one stock, becoming wealthy from that one stock, and then boom, all of a sudden you are a millionaire because that one stock you bought ended up being the next Tesla, Apple, or Microsoft. The answer is no. The game we're playing here is probability. You can buy a stock that's very attractive and the odds are 90% you're right, everything's good, and 10% that the stock is going to do terrible, but you can always experience that 10%. So by buying a few bunches of stocks that you actually like, they're good, and you actually believe in them, overall, you will have better odds. So in this video, I'll tell you about 7 things to ask yourself before you go ahead and buy a stock. And by the way, these 7 ideas come from one of my favorite investor right here, and his name is Peter Lynch. And let me get the picture version because this is going to be a lot better than that. Boom. Peter Lynch, my favorite investor of all time. Well, one of them. And he's so cool because they offered him $15 million a year to keep working. He said no because he had enough and he basically did what he came to do. And to me, that's awesome because that is freedom. Now, watch this video till the end because all these questions are questions that you want to know because if you don't ask them, it might cost you money. Because I got lucky, but you might not get lucky, okay? And as always, guys, like this video on top of also subscribe and hit the bell so you get notified. Now, the very first thing, guys, is basically, number 1, you want to know before you buy a stock exactly what this company is basically doing. What are their services? What are their goods? And what is the actual product that they're actually selling? So overall, you might look at a company like Amazon and say, Tommy, I know what Amazon does. Amazon sells things online, but no, Amazon is also involved in web services, in AIs. At one point, they wanted to get into the phone business. They're also involved, for example, in the movie business now. Amazon has a multitude of businesses, and one of their best sellers is basically Amazon Prime and also Amazon Web Services. So that's where the action money comes from, but most people don't know that. And most people don't know that Jeff Bezos, which is basically the founder of Amazon, his whole goal was to make a lot of money so that he can basically invest that money to go into space. A lot of people don't know that. So overall, before you buy a company, you want to make sure you understand exactly what this company is doing overall. And to find this out, just read their annual report. So type in on Google, Amazon annual report, you get a whole PDF, bunch of information, and then you read that and you get a bigger perspective on the company. Now, number 2 is, how is the financial health of the company? I'll give you guys a brief example here. I have a friend, and this friend is absolutely gorgeous. One of the most beautiful women I have ever seen in my entire life. Now, this lady looks like she's basically walking down a roadway. What do you call those things? I just don't, I don't have my vocabulary, bro. Now, she looks like she just got off a runway. Always wearing Gucci, always wearing Prada. The woman looks stunning. But overall, when we started looking at her books, guess what? She had a negative net worth. When I looked at, for example, the money she earned and the money she spent, she was basically earning less than she basically spent. And that's absolutely insane because that's basically paycheck to paycheck, but you look like $1 million. And that's what you want to avoid. So overall, when it comes to a company, how do you find out this information? The answer is simple. You go over to the balance sheet. The balance sheet tells you exactly what the company owns and what the company owes. So if you see a company that basically they have $1,000 in assets, that's what they own, and they have, for example, $1 billion in liabilities, the answer is something is wrong here. You owe so much money, you have so little assets, and on top of that, I'm seeing your earnings overall on the income statements and you're not really making that much money. So what is going on here? So what is the financial health of the company? It's not just about the brand. I like Apple, I like Nike, I like this, I like that. No, how is the actual health of the company? Now, number 3, what is the earning trend? Now, whenever I'm looking at earnings, that's basically you have a business, the business makes money, that's the earnings, okay? How does that look? Over the past 7 years, over the past 10 years, how has this company been performing as far as earnings, okay? The answer is, if you have a company that all of a sudden last year, they made a lot of money, but then you look back the other 9 years and they're always losing money, you might say, well, this might just be like a one-time thing. This might not be the best company to invest into. But if you see a company that basically has, for example, steady earnings, they go from making $1 to $1.20 to $1.50 next year, $1.75, $1.80, $2, $3, but they have this steady trend that they're basically making more money. Step by step, they're basically growing. Tommy, where do I find this? You find this in the income statement. And it's also important that you realize that as a company is going to be making more money, well, how are they basically capitalizing the entire stock, okay? Are they basically borrowing a lot more money? That's why it's important. Before you look at, for example, the earnings, look at the balance sheet. How is the health of the company? And then go back to what's the trend here? Are they making more money step by step? Or is it showing that they started up here and now they're basically losing more money, okay? Or are they just basically like this? Nothing wrong there, because if I can find a company that is very steady in its earnings and I can buy it at a very steep discount, the answer is, well, that's pretty good too, right? It all depends the price you actually buy in. That's all that's important. Now, number 4, how much is the company worth? Talking about calculating exactly what a company is basically worth and what the price you're actually going to pay for it. Now, obviously, this is simple to actually understand once you understand it. And that sounds like a very crazy thing to say. But the idea is, when you understand a stock is what? A business. A business has one overall purpose: to provide a service to then get money in return. That's what they do, okay? All businesses do the exact same thing. So what do you want to see? You want to make sure that the money you put into a business is going to be used to make you an appropriate amount of money back. And for stockholders, for example, we get paid when the price goes up. If we sell, that's a profit. We get paid if they do a dividend distribution. Basically, we get paid some of the earnings. The answer is we get paid that way too. But also, we also have a return on capital that's actually happening within the company. That basically means, for example, if I put in $10 to the company and they grab this money and invest it into assets, and it basically generates some cash for the company, well, this cash the company basically generated from sales. Once they basically pay all the expenses, all the people, all the employee, the cost of making that money, all that stuff, and then they also invest into the growth of the company. They call that CapEx usually, what it takes to maintain the company overall. Whatever is left over from that money we basically have been investing or the company actually made, that's basically going to be what we call free cash flow. The company's money that's left over after paying for all the expenses. Now, the idea here, listen very carefully. This might not make sense to you right now, but eventually it will, and it will click, and it will make you a lot of money, okay? Whatever the free cash flow is of this company, your job is to discount it against what the current rates basically are. That's the only job you want to do. And when you do that correctly, by getting the net present value, what you're going to get is the value of the company. And they call that the intrinsic value. Tommy, this sounds like a lot of stuff. This is a lot. I can't process this. The answer is, that's fine. But what you're basically doing is, if you have, for example, if this company is making you, let's say, for example, $100,000 every single year, and on top of that, you want to make from this company, let's say 10% or 15%, what you're basically doing is saying, hey, I want to make 15%. The company makes this much over this period of time. So how much money overall is my investment going to be worth that I'm going to put into this company? And to do this, you can use a net present value calculator. or an intrinsic value calculator, you can basically find that online. You can find it on Google. You can find it on YouTube. But if you want your boy to do that video for you, comment down below and let me know, and I'll give you a formula. I'll make the whole Excel sheet for you guys to actually calculate exactly how do you know what the value of the company actually is. And once you know exactly what the value of that cash flow basically is, you can then divide it by the amount of shares outstanding, how many shares are actually out there, right? And then you can know exactly per share, right, what is the amount that this company is worth. So although the price says $10, well, the actual value of the company might be 20. So that means, hey, I can basically invest money into this company and basically make money automatically because it should be going up in the future. That's pretty cool once you understand the value of a company. Or you might see a company that's listed at 20, but the actual value is only $10. And then at that point, you're like, okay, I'm not going to invest into this because it doesn't make any sense. Now, number 5, what protects the company? Said that wrong. What protects the company? There you go. That's proper English there, okay? The answer is, okay, why do you think that I just can't go ahead and grab my phone right here, and instead of having an apple, I put an eggplant here? Why can't I sell it, okay? Why is it, for example, I can't grab my Nike sneaker with the swoosh on it and just basically make an X and sell it, right? Why can't I grab Coca-Cola bottle and put Tommy's Cola and basically sell it? The answer is, right, companies are protected by a lot of things. They're protected by brands. They're protected by the amount of money they basically have, the size of them, the patents they have. What you want to find out is the company I'm going to invest my money into, what protects them from competitors? Because remember, okay, the way this works is just like in the real world, okay? If you have one person that's making money from something, everyone wants to get in. And once everyone gets in, guess what? The money goes down. So you want to make sure the company you put your money into has some sort of advantage to protect themselves from everybody else. That's the idea. Now, number 6, what does the company do with the extra money it makes? Now, this is very important, okay? So remember when I told you about free cash flow, the amount of money that's left over after the company basically pays all the bills and also invests back into the company? The answer is, well, what do they do with that money? Do they use that money to reinvest back into the business, for example, like Tesla does? Do they use that money to pay out a dividend, for example, like AT&T does? Or do they use that money to buy back shares, for example, like Apple is doing right now? The answer is, it depends. And there is no wrong answer here. But for example, if Tesla is grabbing my money, the free cash flow, and they're reinvesting it back into the business, and it's actually making us less money, that's a bad investment. So I don't want that. If Apple is buying back shares of the company to increase our ownership, right? The answer is, if they're buying it at such a high price, the answer is, I don't want that, okay? If a company is paying out a dividend when they can basically get a higher return by reinvesting the money back into the business, I don't want a dividend, okay? That's why so many people invest into Berkshire Hathaway, because they can utilize the capital or the money they basically make to make more money for shareholders, okay? So there's never, for example, a right or wrong answer or a rule of thumb here. It's more like, what is the company doing and why? And it's your job to find out exactly why they're doing it. Me, preferably, I like a company that pays out a dividend. But you want to be careful, because some companies, what they like to do is they like to grab the money, reinvest it, growth. But if it doesn't make sense, it doesn't make sense, okay? Doesn't make sense. Now, number 7, and the last one here, guys, is going to be, do you like the company? Now, this is subjective, okay? Because if I find $1 on the floor, I don't care if I like the president, I'm going to pick it up, right? So if you find a company that's selling for a very low price, right, you're going to buy it because it just makes sense. You're going to make money. But overall, it's a lot easier to buy a company that you like and hold on to it when times are bad than to buy a company you don't care about and hold on to it and believe in it when times are bad. That's the idea. So I found that basically investing into companies that in some way align with your values makes sense. Not just with your interests, because that's different, but with your values. Would I invest into a company that's basically involved in cigarettes or something like that? Or into a company that's involved, for example, in something that's very immoral, right? Probably not, because I wouldn't want to be a part of that. Remember, right? When you buy into a stock, you are an owner. You're putting your money to work into that company. So basically, you're funding that. Now, I'm not going to talk about here like, oh my gosh, you got to save the planet and the plastic and this and that, because that gets into a whole different thing. Because in the day, as an investor, you want to make money, but we all have different values, and it has to align with your values. If you don't care about what I just said, that's fine. That's your values, and that's your business, not my business. I like this. You know why? Because I can do what I want, and you can't tell me what to do. Okay? That's why I talk the way I talk. Now, guys, that is basically it. These are 7 questions that you want to ask yourself before you go ahead and buy into a stock. This is very important, because if you just buy a stock based on the price, it's going to be a bad deal. You know, there was a point in my life before I learned about investing that what I used to do was basically I would go to the stock page, I would look at what the last price was, the lowest in the past 52 weeks, and it was like, for example, $10. And right now the stock was like at 15. I'm like, yo, it went from 10 to 15. Interesting. And then I would find another company that was basically, it used to be 15 and then it was 10. I'm like, I could go back to 15 potentially, right? And I would just basically just invest on what the company used to be or what the company could be, okay? It's a terrible thing. It's a terrible investment strategy. Investing based on price. Always invest in value. And the entire thing we're trying to do as investors is we're trying to get value for less than it's worth. And that's where we basically make the money. And whenever you're invested into a company, your analysis is not going to be perfect. So you want to make sure you account for errors. So if you figure out the price of the stock is basically $10, well, buy it, for example, at $5 or $8 or $7. That way, if there is a problem, you have enough margin of safety to adjust for it. But that's another video for another day too. Guys, thanks for watching. I appreciate you guys a ton. And as always, guys, like, subscribe, hit the bell so you're notified. On top here is another video, and comment down below stock so I know you made it all the way to the end of the video. And on top of that, we have a goal, 500K by the end of the year. Subscribe to the channel right now. It helps out a lot. And on top of that, also follow me on Instagram at TommyBryson. Up here, another video. Over here, my face. Subscribe. And as always, long-term team officially